All right, my friends, so I just got done doing a video on Vanguard where they talked about using the Roth IRA as a estate planning tool. Sitting here waiting for one of my kids to get off the bus. Nice thing about working from home is you get to, you're around. A nice day out here in Georgia. Just got done listening to some Pogues too, so it's a good day to share with you something else I want to talk about. Why an IRA is the worst asset you can have in retirement. You want a taxable account more so than an IRA. And I can hear people, Josh, that's crazy talk. Trust me, man. The Vanguard, look, you don't have to believe me. Listen to Vanguard. Vanguard said explicitly, it said, a Roth IRA, you don't want embedded tax accounts, embedded taxes in your accounts. You want accounts that don't have embedded taxable gains in there, i.e., IRAs, 401ks, employer-sponsored plans. It's better to have taxable accounts and Roth IRAs, especially when it comes to transferring of assets to your kids. But what Vanguard did not say, which I would say is even more important too, if you're not all that concerned about transferring assets to your kids, is just the IRA distributions that your accounts give you. I mean, I've talked about this a million times a Sunday, but of the three types of accounts, tax-free, taxable, tax-deferred. We want minimal tax-deferred, maximum tax-free, and if we can't get a complete tax-free, we'd rather have taxable than tax-deferred. Tax-deferred is not your friends, my friend. It's not your friends. Taxable is. Deferred simply means you're deferring the taxes to a later date. That later date is when, i.e., you have got to start taking distributions because the feds make it through RMDs, required minimum distributions, or they start saying you're going to give it to your kids. And when you give it to your kids, they're going to take those distributions at the most inopportune time because they have required distributions as well. Secondly, what happens if you have to take a distribution because you got to get your roof fixed? So you got a $25,000 distribution because a tree fell on your roof and your homeowner is giving you a runaround. Well, you got to pull that money out of your IRA. That money is going to be taxable as ordinary income. Thirdly, and I hear this all the time, I have my accounts that I don't need long-term care. You might not need long-term care, but let's just say you have $60,000, $5,000 a month for a nursing home. All right, you got to pay $60,000 a year you're going to be pulling out of your IRA in order to pay that nursing home cost. How much of the tax is going to be on that? Well, let's just say you're in a 20% tax bracket. You're going to add 20% to that $60,000. What's that going to be? $12,000. So for every $60,000 you're pulling out, it's actually you're pulling out $72,000 because you got to pay tax on that. So now you got nursing home, that's $5,000 a month. It's probably going to be more than that, my friends. Then you got to pay the tax on that, which is another $12,000. That's $72,000. And well, what happens in IRMA? Remember IRMA, the income, oh man, I can't remember. The income required Medicare, I forgot what it is. It's the Medicare premiums that you pay if your income is above a certain threshold. So now we're married filing, we're a single taxpayer because our husband's died. We're going to assisted living or a nursing home. We got $72,000 a year coming out, $60,000 to pay for the nursing home distributions, or the amount to pay for our nursing home, plus the taxes we got to pay. That's $72,000 right there. We're still going to have Social Security. All right, so Social Security, we take half of the Social Security to add to our income for provisional income. I'm telling you right now, you're going to have 85% of your Social Security be subject to taxation. I can see that from a mile away because you have $60,000 of income, plus $72,000 of total distributions for taxes. So now 85% of your Social Security is going to be subject to tax. Your modified adjusted gross income, remember, modified adjusted gross income, right now, if it's above, I think it's $78,000, maybe we'll just say $80,000, you're going to have a 30% increase on your Medicare Part B and Part D premiums. And if you think that's going away anytime soon, you don't know how Medicare is structured. It's in a whole lot worse world of hurt than Social Security. So now you have $5,000 a month coming from your IRA going to a nursing home. All right, you got to pay tax on that. There's no tax-free distribution when it comes to nursing home. Plus, you got your Social Security. Plus, you have any other kind of account that you have. All that is going to go through into your tax bracket. You're going to be subject to income tax, subject to Medicare premiums on Part B, Part D. It's going to make your IRA, your Social Security subject to 85% of your Social Security will be subject to taxable income too. So, what's the benefit of doing it while you don't have to do all that, i.e., moving money over from a traditional to a Roth, or even just taking it to a taxable account? I don't know why you do that, but even if just taking it from a taxable account, well, it's simple. Take advantage while your income is low, where you're not taking $5,000 a month distributions to pay for a nursing home. Take advantage of you not paying $5,000 a month for the nursing home, and you have 2 merit standard deductions, you and your spouse. When your taxable income, your brackets are higher. So now you got 2 standard deductions. We need $170,000. Something like that, 180, yeah, 70,000 before we got Medicare premiums going up, all right? So take advantage of the Roth now. If you're married, filing jointly, and you're concerned about going to a nursing home, you're concerned about any of that stuff, take advantage of the tax code now. The married filing jointly status, the higher tax brackets that you have. A single taxpayer, 0 to 10,000 is a 10% tax bracket of taxable income. Married filing jointly taxpayer, 0 to, was it 20,000 is a 10% tax bracket. And then for a single pay, then 20,000 for single, I can't remember off the top of my head, but basically it's double is what it is. So 10,000, I think the next time for the 12% tax bracket goes 10 to 37 if you're single, if I'm not mistaken. And if you're married, filing jointly, it goes 20 to 77, or 20 to 80,000 roughly to stay in the 8 to 12% tax bracket. So you have that, you have twice as much income to stay in the same tax bracket. Plus you have 2 standard deductions. So remember, income, your taxes based on your taxable income. Your taxable income is after your standard deduction. So anyway, so just as Vanguard confirmed, it's better to have taxable accounts than accounts that have embedded gains in them that are going to be taxed later on. It's for everybody's benefit for sure. Now, if you're single, it's a little bit different, all right? Because if you're single, you want to take that money out of your IRA while you can manipulate it, as opposed to when you're forced to through the IRS or RMDs, or through when you have to take standard nursing home distributions. You still rather start maybe doing that quicker if you think there's a chance you might have large distributions in the future because of nursing home. That's a different one, but still, take it while you are in control. If you're 65 years old and you're not at RMD stage, you got 150,000 in your IRA, you're like, I'm gonna start pulling money from this just so I can pay the tax man now as opposed to waiting. A single or married filing jointly. That's a wise move to make. All right, so I'm gonna post my video on Vanguard here in just a second, so stay tuned and we'll see you next time. Thanks now.